You may think this panel is quite dull. It has something to do with regulation. But actually, we're going to retitle it. This panel is really about the structure of the United States and whether it has been restructured in the correct way. And I have 3 speakers, all distinguished, to help me on this. So the first person to come out is Eugene Ludwig, who was controller of the currency in the Clinton administration and is now head of a financial consultancy. Eugene, would you come out? The second person is Karen Petrou, who has been a financial industry consultant for the past 20 years and is quite well known for her work on the financial industry. And finally, Peter Wallison, who is the White House counsel under Ronald Reagan and the counsel to the Treasury, who is now with the American Enterprise Institute, which tells you nothing about his views. This is a very brief panel for a very, very big subject that is more interesting, I promise you, than I think you can imagine. This is going to be a very, very disciplined panel. I'm going to have 2 rounds of questions. But if you have a question for the panelists, now the lights are quite bright here and it's hard for me to see, I would like you to raise your hand immediately. And I will try to see who's out there who has something that you want to add or you want to challenge. And by the way, challenging views are welcome. If you have a criticism, I'm particularly interested in hearing what you have to say. So with that, let me start with Peter Wallison, and let me ask you a question. America went through a profound regulatory reorganization 3 years ago. And I would like to know, in your opinion, was it in any way successful, and if so, why?
No, I think actually it was completely unsuccessful. In fact, I'd say this is wildly off track right now, the Dodd-Frank Act, and on its way to being an actual train wreck. There were 240 or so regulations that were required in order to make this statute operable in some way. Of those, 1/3 have been finalized in the 2 years. 1/3 have been proposed but not finalized, and 1/3 haven't even been proposed at this point. Now, the amount of uncertainty that this creates for the financial institutions, for the financial market in general, for businesses that have to deal with financial players in one way or another, is enormous, and I think it's one of the reasons why we have had such a very slow recovery. If you think about the major elements of the Act, for example, the Volcker Rule. Now, the Volcker Rule says that banks, many of you may know this, of course, says that banks cannot engage in proprietary trading. But they can engage in market making and in hedging. Well, how do you craft a rule that describes the difference between proprietary trading and market making or hedging? You can't do it unless you are inside the head of the person who is actually doing the trading. So you can understand why the Volcker Rule has not come out in final form yet. The regulators are fighting about that. In the housing area, which is another very important area because housing actually caused the financial crisis, there have been some efforts to improve the way securitizations operate. But that created 2 new concepts completely and were never defined: the qualified residential mortgage and the qualified mortgage. In the case of both of them, they were not defined by Congress, left to the regulators, and the regulators have been fighting about them ever since. They could be highly consequential when they actually come out. In the derivatives area, and again, there's so much uncertainty because of the lack of this regulation in the housing area that is also preventing a recovery of the housing market and the ability of people to get mortgages. In the derivatives area, which was largely unregulated, this is the swap area, the CFTC has really done a lot. They have come out with a tremendous amount of regulation and final regulation. They've been, you might say, the most diligent of all of the agencies, but they have been so diligent, they have produced something that the swap industry can't live with. So the swap industry has gradually been moving toward creating things that they call futures on swaps. So they can actually operate in the futures environment without having to get into the swap business. this is an extraordinary strike by a whole industry, it seems to me, against the regulations that have come out. And finally, the one that really worries me most of all is Title I, because under Title I, 36 banks are designated, in effect, as too big to fail. That's 36, that's not 5. That's 36 banks, and it seems to me, when you designate these institutions as too big to fail, and you say that they have to be stringently regulated by the Fed, you are handing a gift not only to them, but also to creditors, because creditors love the opportunity to make loans to organizations that will not be allowed to take risks, because that's what stringent regulation probably means. And the worst part of this is that we are extending too big to fail to an entire industry, an entire financial industry beyond banking, because the organization that is to oversee this, the so-called Financial Stability Oversight Council, is able to designate non-bank financial institutions also as systemically important, and that will be interpreted as saying that they are too big to fail. So we cannot solve the too big to fail problem for banks. In fact, we've made it worse. And for non-bank institutions, we have suddenly, for the first time, included them in the category of too big to fail.
So I think what Peter's saying is, in certain areas, the bill is incomprehensible, and that's awful. And in certain areas, it's comprehensible, and that may even be worse. Karen, what do you think?
I agree on the, if not incomprehensibility, confusion point. On Tuesday, my firm put out a study that, Tom, we briefly discussed, in which we tried to map not only all the US rules under Dodd-Frank and the others in the works, but also the global rules like the Basel III, capital rules, liquidity, the ring fencing, and the QRM securitization rules here. Anyway, we did a map to try to look at the rules to see what their key provisions are, what was intended in them, and what the possible unintended consequences or even perverse results might be, not only rule by rule, but comparing the rules in their entirety to look at what the sum total impact of these rules. And I came away saying we just see bumper cars. Very, in many ways, well-intentioned rules are so detailed, so complex, and so in their own heads, if you will, that you see capital rules that collide with liquidity rules, capital rules that collide with making central counterparties, a Volcker rule that collides with the desire for hedging, and many other types of collisions that are unintended, but very not only dangerous, but really destructive to the fundamental competitiveness of banking organizations under the bulk of these rules. That creates one massive perverse result, which is encouragement of shadow non-banking institutions. Now, I must disagree with Peter. I do think one part of Dodd-Frank is very robust, and that's Title II, which creates the Orderly Liquidation Authority. Another piece of work we just released tried to take a hard look at the law, the rules to date, how it fits into the broader context of rules, particularly the living wills, and what the US regime for ending too big to fail means in the context of global work. And I would agree the global framework is doing nothing anytime soon on too big to fail. But I do find that the US Title II Orderly Liquidation Authority is a very robust end to too big to fail. And Peter says that Title I makes a lot of big banks too big to fail, and that's so great, but they're being very, very noble, because every institution that thinks it might be named systemic is seeking every way it knows how not to be. And that's because the rules for these institutions, I think, will be quite tough, and the new resolution regime means they're on their own, even in a significant risk and stress situation.
So let me get this straight. It's in the well-crafted features of the bill, it's basically contradictory. We have a bumper car situation. Therefore, mostly it's a disaster, but there may be a bright light in this picture. We'll have Peter attack that later. because I don't want any of you going away with a shred of optimism, though we will have a one. Now, what do you think?
Well, the bill is overly complex, that's for sure. And some who have bombastically said it saved the financial system, I think that goes too far. But there are a number of provisions that I think make the financial system safer. And happily, we do in fact have a much safer financial system today than we did prior to the crisis. So, for example, the resolution and recovery regime that Karen alluded to, I think is absolutely right. It's a good set of provisions. In addition, the stress test, the fact that we have an orderly stress test approach that stresses the largest institutions, and now they're doing the smaller institutions, that they look, what would happen in a crisis? Do I have enough capital? I think that adds value. And most importantly, one of the hidden, I think, features of the bill is that it looks at the macro-prudential, the big macro events that could happen, sets up an organization called the Office of Financial Research to try to figure these out. Where's the bubble going to arise? And then encourages the regulators to, and this is mostly the Federal Reserve, to think about these bubbles and take action before they happen, because the normal tools of regulation and supervision, however good they are, don't really function in these 100-year flood environments. So that's a plus, but it is too complex, and I view the bill fundamentally as transitional, Tom. I think that, it's not going to go away, it's not going to be repealed, it's a little like Glass-Steagall, it'll be a political football. But we have to transition to a simpler system, and I think we can do that. As I say, a few of the provisions that it has in it are of value. And a simpler system is, I think, reasonably easily constructed. It ought to have really two pillars.
Well, this is my next question, but
go ahead, I'll
do you have
wait.
any other things you want to say about whether this succeeded or failed?
I think it's a mixed bag. I think we're better off that we have some of these provisions for sure, but the complexity does put a drag, I think, on the country.
Let me get this panel to, do you all believe that we have a safer, how did you put it? We have a much safer system, was your comment. Do we have a much safer system? Do you believe we have a much safer system, Karen? Do you believe, Peter, we have a much safer system today than we had before?
I don't believe we made any significant changes. And in fact, Title II is one of the most troubling changes, because I don't think
so let's stop on Title II for a second, because for many of you, I will tell you, having read Dodd-Frank, that this is a physically painful process, that at Buttonwood we are actually sworn to protect you from having to actually confront. But given this protection, it is hard to approach it with any sort of context. So why don't, Peter, or why don't we just have 1 minute to describe what Title II is? Peter, why don't you start? But Karen, if you disagree, please weigh in.
Yes.
And then please attack it.
I have a dog with very large teeth down here.
I'm sitting far enough away.
I mean, the very words Title II are the type of things that make you shut your eyes. I'm telling you, this is your financial future going off a cliff.
Title II is an extraordinary piece of work, and let me explain why. Most of you, if you haven't read it, will be shocked by this. But in Title II, the Secretary of the Treasury can decide that any financial institution that he believes is close to failure, and if it fails, will cause distress or instability in the U.S. economy, the Secretary of the Treasury, after consulting with the Fed and the President and so forth, can seize this institution and hand it over to the the FDIC for liquidation. The institution can object, but if they do object, the Secretary can go to a court. The court has 1 day to determine whether the Secretary is reasonable or not. And if the court doesn't act in that day, by operation of law, that company is turned over to the FDIC, as I suggested, for liquidation. There are no appeals allowed and no stays allowed. So in other words, the Secretary of the Treasury has all power over all financial institutions if he believes that they are possibly failing. Once they get to the FDIC, let's assume they do, there isn't any difference between bankruptcy and what happens in Title II in this sense. What happened with Lehman Brothers was the market was shocked by the fact that Lehman Brothers failed, went into bankruptcy. It wasn't bankruptcy itself that caused the problem. It was the fact that the market did not know what the policies of the US government were. And if we are in the same situation at some point, and the Secretary of the Treasury grabs a company and turns it over to the FDIC, the market is going to also be shocked. And people will run from all other institutions that the Secretary might treat the same way. So we do not have a cure for the problem of organizations becoming insolvent. Title II does not do that. It does not cure the too big to fail problem. It makes things substantially worse because people will see it as a bailout proposition.
Karen.
Well, I didn't quite follow the end there, Peter, because you said that the Title II process would panic the markets because one firm would go insolvent and everyone else would run, but then that creates too big to fail. And I think maybe we'll need to step back. But I guess I don't, and you are a distinguished counsel, and I would defer, except now I won't.
There is no need to defer while you are here to anyone. And the audience should feel the same way.
Yeah, I don't think the law says that. And we've had this history of a regulator being able to seize an institution anytime he or she wants, and that's in the FDIC receivership powers. Actually, the FDIC can seize an insured depository for far less robust reasons than are specified in the statute. And I don't think, Gene, if you know of a wanton appropriation of a bank, please interrupt, but I don't think we know of a case in point. We have a rule of law. The tests in Title II are very stringent. That process of the Fed would not gloss over that process. It's an important one in the law. The criteria are significant. The Treasury does have extraordinary authority to move quickly, but that was done because in a crisis one might need to. The details of what then happens, first of all, it's very important to remember that the law stipulates that creditors get no more than in bankruptcy, and the institutions themselves, if they were named systemic before, must have filed credible plans to prove they can be liquidated under the bankruptcy code. That's a very important piece of the law, which has never happened before. It makes the stress tests that Gene talked about look like kids' stuff. This is a very serious exercise for any institution in the middle of it. There's many complications still to be resolved, but I think Title II is quite robust.
This is an important point, and I'm going to go to Gene, and then I'm going to go back to Peter. And I hope you guys don't feel squeezed out. There are probably some authorities here too, but please.
Well, the bankruptcy code itself is this thick, and I'm sympathetic to anybody who has to worry about sort of taking something apart when it really gets that sick. But the fact of the matter is that you have to have a rule of law around what happens when things go bad. Financial institutions are special, particularly banking organizations. And so to have a regime that applies to large banking organizations when they really get that sick is a sensible thing. Now, what I think this resolution recovery approach does that really is a step forward is it asks in advance for these institutions to think about, okay, what would happen if things really went off the rails? What would you have to do? And that process, a number of bankers have told me that when they started the process, they didn't think much of it until they went through it. And they began to think about their institution. What could really go that bad? What would it be like if I had to take it apart? And I think that has added value to the safety of the system, in addition to being a mechanism you really have to have if you have a crisis. So I think it is a step forward. Nothing's perfect, and it is complex. But I think the nature of that kind of rulemaking is complex.
It's a step forward and it's 2 steps back. I mean, there is something, I think, in this idea of the living will that they describe what it is will happen to them if they were to become insolvent. But the problem is, the reason, and I want to answer Karen's question, the reason it creates too big to fail is because creditors know exactly what's going to happen. The way that you protect against runs is to provide financing for the short-term creditors, the people who could run. And that's what the FDIC is empowered to do. They can set up a separate institution called a a bank of some kind.
Oh, you mean a bridge, I think, Peter.
I'm sorry?
A bridge?
A bridge institution, that's right. A bridge bank or a bridge institution. You set one up, and then you can borrow money from the Treasury. They have a line of credit that they can borrow from the Treasury based on the assets that they put into this institution, and then they can use it to pay off the creditors who might run. And that would stop runs from happening in other places, but from the standpoint of the creditors involved, that is what creates the moral hazard that produces the too big to fail problem, and that is creditors believe that they will not be hurt if they make loans to these institutions, especially these very large ones, because eventually they will be treated better than they might be treated in a bankruptcy. That's what we should be avoiding. We should make sure that as few institutions as possible are going to be eligible for anything other than bankruptcy, and maybe no institution should be made eligible for anything other than bankruptcy. But every time we create a situation in which it is possible for these institutions to be treated differently, to be stringently regulated, or to be taken over by the FDIC and liquidated or resolved in some way, we create much more moral hazard, and we spread the problem of too big to fail and moral hazard throughout the rest of our economy.
Just to push this one step further, there are a couple provisions in the new banking laws that say that stress tests, which you mentioned, that allows the government to evaluate loan portfolios. There's something called living wills, where everyone has to write about what they do and how they'll unwind. Both of these things are reviewed by regulators. So all of a sudden, you now have regulators in the position of saying, this bank is doing appropriate things, this bank has an appropriate loan portfolio. Are any of you worried about the nationalization of finance in the United States, the nationalization of credit in the United States, and therefore the politicization of how credit is allocated in the United States, that we have inadvertently become China?
Tom, I think that your worry that we have, and we've discussed this before, too many regulators is absolutely fair. We really need in the country a more simplified regulatory mechanism. That's why I'm hoping Dodd-Frank will be transitional. But financial institutions, particularly banking organizations, but I would say the entire financial spectrum, I'm no big fan of the shadow banking system. I think it's one of our problems. Really, to function correctly, needs some level of regulation. And what I would do, and I think we must move in this direction to have a robust economy, is to have bright lines minimums for the entire system. Good capital. I'm a huge fan of using the allocated loan loss reserve. A few bright line minimums, and then a supervisory mechanism that is massively simplified but effective. Because the problem is, if you're going to have a robust, flexible financial system and have it safe, you have to have a supervisory mechanism that makes sure that, in fact, they're playing by the rules. We have too many supervisors right now. A single supervisor, prudential supervisor for the financial system, which, by the way, they have in Canada and Australia, two countries that went through the crisis time quite well, would serve the country well. And if we can't get to that for political reasons, we at least ought to have the mechanisms simplified so that one supervisor deals with an institution every year and we don't have 3 or 4 tripping over each other. And I think we can get to that even with the current regime. The second thing in our supervisory mechanism is in this country you can get a degree, Tom, I think in probably everything, including basket weaving. A college degree, but you cannot get a college degree in regulation and supervision, and we have to give our supervisors the kind of wherewithal so they can be more effective. That's something I think ought to be a national priority. But we need a simplified system. This issue of the allocated loan loss reserve is profound. It's one simple rule that was in effect in the 1990s and before. Because of accounting changes, we eviscerated it, and it wasn't available in the crisis. It's a rule that allows bankers to set their own provision, their own cushion, under the rubric of the prudential supervisor, and so that they have a real cushion they can use in a financial crisis. This simple rule would make an enormous difference in the safety and soundness area, and it allows management to be responsible. That's the kind of thing we can have, sort of some limited simple rule.
So this was the second part of my, first was it effective? And the second part of what I wanted to ask is, what do we do with where we are right now? So thank you, and Karen, and then Peter, and you can ignore my accusation that we've actually become a socialist regime in the process of regulating. But anyway, Karen.
What to do now? Again, I know, Peter, I would like first to finish the build out of the orderly liquidation authority, because I think if we have a clear resolution regime that the markets understand ends too big to fail, we do two things. One, the markets will do a lot of the reforms with which regulators are struggling. If the markets think a bank's too big, they won't spend the next 5 years figuring out what the right size limit is. They'll chop it up for you, punishing the institution in the markets, forcing divestitures and so forth. I'd like to see as much market discipline as we can, as fast as we can. We need some capital rules, we need liquidity. I think most importantly, we need better corporate governance. And we need, I agree with Gene about regulators and supervisors, but I'd like to see that much more transparent so we can hold the supervisors accountable, not just the bankers. The bank supervision process is very opaque. You never know what an institution's rating is, whether or not there are any enforcement actions, and so when everything blows up, the fact that the only institution we could hold accountable in the United States was the incredibly inept Office of Thrift Supervision really speaks to the fact that we don't hold the supervisors as accountable right now as we're holding banks. So I'd like to make that a priority too.
You know, I'd like to just respond a little bit to your remark about whether we have become a kind of a socialist country in a way by taking over these financial institutions, and I think this is truthful. There's some truth in this.
I think you should listen to this man because he is agreeing with me.
Don't hold this against me. Karen pointed out that many firms, despite the fact that they are quite large and are in the sights of the Financial Stability Oversight Council to be turned into or created as or called or designated as systemically important, are resisting that, even though I say that they get benefits from that, and I think they will get funding benefits from that. But why are they resisting it then? And I hear this all the time from people who support Title II. The reason they are doing that is because they are taken over by the government. This is much like the Affordable Care Act, where the institutions involved, that is, health insurers, are left standing, owned by shareholders, but completely controlled by the government. And the same thing is happening now in the financial area. The companies that are designated as systemically important will be taken over by the government. And despite the fact that there will be benefits coming from that, the CEOs and other people in those companies do not like the idea that they are going to be taking going to be taking orders from the staff of the Federal Reserve. This idea that they will be stringently regulated, we do not understand entirely what that means yet. There's a proposed regulation, but we don't know the full extent of what stringent regulation will mean. But for most of these institutions who think that they might be turned into systemically important institutions, or at least called that by the FSOC, want to avoid the kinds of controls that will come with that, even if it ultimately allows them to leave the office at 3 o'clock and play golf the rest of the afternoon instead of having to compete with the smaller institutions in their field that won't have the benefits that they will receive. So I think this is a very key element of this law. Now, as to the law as a whole, I don't think there's much to do about it except to say the emperor has no clothes. This thing should be repealed and then replaced with the kinds of suggestions that we've just heard from this panel. There are things that we might need that supplement regulation in general. But this entire law is going to continue to suppress growth in our economy because it creates so much uncertainty. And as long as we leave ourselves in a position where new regulations are going to be coming out for the next 2 years under this law, people are going to hold back in investing in various areas. And once the regulations are out and start to be imposed, there will be the lawsuits that all of these industries are going to bring to try to stop these regulations from being imposed on them, and that will create even more uncertainty and loss of investment and growth in our economy.
I want to do two things now. I want to turn to Eugene, but before I do, is there any way we can turn on the house lights? Because if any of you are raising your hand, I can't see it. And I'm very, very curious if any of you have any questions or comments. Is there any way to turn on the lights of the house? Great. So please raise your hands now if you have it. But in the meantime, I'm going to turn to Gene to comment on that.
I want to turn to your provocative question about credit allocation, because I think underlying that question is a profoundly important premise, and that is that regulation and supervision have enormous impact on the well-being of the economy. And that's true for good and for ill. Too little of it, we saw what that was like. I'm a big believer in markets, but an entirely market-based supervisory system, which we really tried to go to in the aughts, doesn't work. Similarly, an overly complex and intrusive system does have the kind of externalities that you're concerned about. Although it tends to be an arcane and in some ways overly boring subject, lots of pages, lots of things to think through, it's incredibly important. And one thing I think is fascinating is there's very little real scholarship about this area. In fact, I'm very involved myself in setting up a foundation to do real study about what works and what doesn't work. Surprisingly little scholarship. So in the capital area, in terms of how much capital, how the capital should be constructed, it's remarkably thin. And if we're really going to have a safer financial system in an era that is so much more complex and globalized with technology changing things every day, we must start studying this in a serious, rigorous academic fashion.
Oh, there are some questions. Okay. I have a couple myself, but yeah, please. Identify yourself, and if you speak too long, I'll cut you off.
Okay. Peter Wallison, Oak Hill Advisors. Quick question. I've been surprised that on the panel there's been no mention of accounting improvements because you look at a bank balance sheet, it's really hard to understand. Is that because you think that accounting is okay, or it just was a topic that was missed? Thank you.
All three, please.
Well, my favorite accounting change would be to stop the rigidities on the allowance for loan loss reserves I mentioned. This is a very big deal because what the accountants have said is unless you go through a rigid formulaic exercise, you cannot set your provision, a safety and soundness cushion that will help you in a crisis. And the problem is that capital is a good thing. No former regulators say capital isn't a value. But the problem with capital is it's kind of like a line of credit you can never use. Because you get into a crisis, and whether it's the markets or the regulators, if you start sucking down your capital in a crisis, people freak out. The regulators punish you. The markets begin to, your stock gyrates. The advantage of the allowance is it historically is that cushion that is meant to be used for a rainy day. And the only reason it's not available, and wasn't available during the crisis, is the accountants say, but look, if you can't prove that there's a loss in the portfolio, you can't basically have a cushion. That's a little strong, but you've got to do it in a very formulaic way. And the problem is that you get formulas and they're backward looking. You really want people with judgment to go ahead and say, look, I want a bigger allowance. Right now, while we have Europe in difficulties, et cetera, a number of banks have been forced to take their allowance down, taking into income today, showing bigger profits because the accounting rules require them to take the allowance down. They can't show the losses. It's crazy, and it is a very big deal.
Is there another question up here? I think I probably missed it, but let me just ask. You guys, is there, where? Yeah, please.
What would you do to prevent regulatory capture?
Excellent question. Did everyone hear that? The question was, what should be done to prevent regulatory capture? And so when I turn this over to the panel, please define regulatory capture before you answer the question. Karen, would you like to?
Oh, I would define it as we saw it at the classic example of that was the Office of Federal Housing Enterprise Oversight, which was the regulator that did us so well on Fannie Mae and Freddie Mac. They came up with a capital rule, a very complex 2,000-page risk-based capital rule that really amazingly found that pretty much every day Fannie and Freddie needed zero risk-based capital because they were just so damn perfect. That's capture, in my mind. I think you avoid it in large part with the transparency I mentioned. Governance of the regulators is very important. Their independence, their insulation from political influence. But I don't see, this is a real sunshine is the best disinfectant in my opinion.
Peter?
I have a minimum high regard for regulation in general. I think that market discipline is much more important and successful than regulation. I don't think we can avoid regulatory capture. It is inherent in the regulatory process. And the classic example for me is the Federal Reserve, which was, in a sense, a systemic regulator of the financial system up until 2008. They were the ones who had the oversight over the broadest portion of the financial system, and they did not spot the kinds of things that caused the financial crisis. So we rely on regulation. We shouldn't, because that also creates moral hazard, because people think, well, the regulators are looking over their shoulder and the regulators are preventing them from taking risks. And in fact, that isn't what is happening. There is an agreement, a cooperation between the institution that is regulated and the regulators that is regulatory capture. And it's been noted for 50 years that this happens. So we ought to recognize the limitations of regulation instead of trying to cure the problem. It just can't be cured.
Before I go to Eugene, where are you from, may I ask?
Originally London. I live in LA.
Do you work for a financial institution, or do you?
No, I'm a software developer in healthcare.
Interesting. Okay. Good.
Well, I think the issue of regulatory capture is a serious one, but I think you can't underestimate what fine people actually go into these regulatory agencies with a general sense of public purpose. What I think has been wrong in the system is that we have had a system that allows for arbitrage. You can choose your regulator. And that was certainly true with the thrift organization. That has got to be changed. We really need one regulator. You get the prudential regulator, just as you do in Canada and Australia. The second thing is we really went through a period, to Peter's point about the Fed, the period of the aughts was a period in which we tried an experiment. And the experiment was, let the markets really do the regulation and let's pull the regulators back. I'm no great fan of overregulation, God knows, but we need firm regulatory minimums, a box, if you will, in which the financial institutions can be free to operate.
You know, oh, there's a question. I was about to say I find your comments stunning and wrong, but instead we're going to go to the audience over here. Did someone have their hand up in the middle of the room? Yes, could the microphone go there, please?
ANCAST, in an article I read in The Economist months ago, and it was, the theme was regulation, and the concluding sentence of the article was, perhaps we wouldn't need all this regulation, this recent regulation, had more people involved in the crisis gone to prison. And we've got civil, I guess we have criminal or not, but I don't know if anybody here would like to comment on that thought.
Well, I'd comment that mere stupidity is not a crime. And what happened in the financial crisis was not, despite what one might read in the newspapers and so forth, what happened in the financial crisis was not deliberate deceit, fraud, cheating, perhaps in very small degree in certain places, maybe in mortgages, but what the institutions did was they bought what they thought were AAA rated securities that they thought actually would retain their value. And of course, we know now that the rating agencies did not do their jobs properly, whatever that job might have been. And all of these banks and others that bought these things, taking the lower yields that a AAA security would provide to them. In other words, they weren't looking for risk. They were taking lower yields. And in the end, they suffered the loss because of the lack of information in our economy about the number of subprime and other weak loans that were outstanding. So I don't see that there were crimes committed here, and that's why people didn't go to jail. There are plenty of lawsuits. There are plenty of lawsuits now, and institutions are paying. But again, the people who ran these institutions, by and large, have lost their jobs. They've lost their reputations. But they didn't do something that would cause them to be individually liable, it seems to me.
Any comments? We're really out of time, but I don't want to cut anyone off. Any comments on that? Failing consultants as well as institutions?
No, I do think there were sins of commission as well as omission. And the complexity of the rules makes it very hard to prosecute, as well as in certain key cases. And I will again cite Fannie and Freddie as examples, where when the examiners blessed things, the management and the boards had a ready defense. And that's where we need to rebalance the process and hold boards a great deal more accountable than we do right now.
Gene, you haven't had a chance to.
Well, I'm dying to find out why it is my dulcet words of sanity and balance. But
so I want you to invite you to Buttonwood next year when Eugene and I will continue this discussion.
No, but I'll tell you, this has been a great panel, and these are, as I said, Tom, I think enormously tough and important questions that deserve an incredible amount of study and thoughtfulness. And there's a reason, I think, that the public genuinely is now concerned about this entire area, because it is so important. And in our modern world, where we really need a financial system to support the economy, because we're not going to have a robust economy without a robust financial system. And I'm afraid you can't have a robust financial system without a sensible, balanced set of regulations. And getting that balance right so that we aren't overly intrusive and overly complex, but at the same time really provide an honest and clear set of regulatory minimums, a real structure with real supervisors well-trained is going to be one of the critical questions for a successful economy in the future.
So let me say two things. I want to thank the panel. There's a coffee break coming up. After the coffee break, we will have comments by Luigi Zingales, who is probably the office heir of the professor who did the original work on regulatory capture at the University of Chicago. He's also the most charming human being who has ever existed. So please bring, I know you're not allowed to bring your coffee in here, sneak it in, regulatory offenses, whatever, but you're not going to miss he only has 15 minutes and you're going to want to listen to what he has to say. Meanwhile, I wasn't able to ask my panel a couple questions, most importantly, what can be done now? But I really want to, please grab them outside, and I want to thank them for the help that they've given me today. Thank you very much. Bye-bye.